We saw a good day on the market, and I think it was a combination of factors which really helped the Aussie market today. The market was up by 0.7%. Here domestically, housing finance numbers came in ahead of expectations, up by 2.4%, although we did see ANZ job ads down by 2% in the month of August. But over in China, we saw inflation numbers quite benign at 2.6%. And of course, over the weekend, we saw exports growing ahead of expectations at 7.2%. In fact, we're seeing the Shanghai Composite up by 3.25% at the moment. And then in addition, we've also heard that Japan has won the 2020 Olympics.
Hooray!
That's going to be a cost of $5 to $6 billion, which is estimated at the moment, and economic benefits of around about $30 billion. And that's quite a conservative estimate coming through from the Japanese government, because that only includes direct spending. So expectations that there's going to be massive construction by Japan, building 10 new sporting venues as well as 11 temporary ones. And the Olympic Village as well bodes well for the miners today. So the materials sector on our market, the outperformers up by 1.3%. Once again, we saw defensives underperforming. We saw the utilities as well as the consumer staples space losing ground. But all in all, we saw a post-election rally, a bit more optimism coming into the market, some domestic numbers out. China's doing well, Japan's won the Olympics. It was a good start for our markets.
A market or majority of things being priced in. September's meant to be what traditionally, historically, a pretty subdued month.
It is a subdued month, and we also go into another dangerous month, which is October. But I guess if we have a look at what's been in the way of markets over the last couple of years, it's concerns around global growth. And this picture is starting to brighten. We've seen some stronger numbers coming out of China. We've seen manufacturing numbers impressing from all over the globe. And of course, the numbers slowly getting better over in the US as well. So I think the market taking a brighter view on the global outlook. And that's one key thing. The other thing that we're watching is Syria, and that's still bubbling away in the background. So that is a key risk for the market. We have a look at the market over the last 30 days. This is what it looks like, and it's actually been quite a good rise for the Australian share market. You can see that we've topped out at 5,200 points, and that really remains a resistance mark for the market. If we can get above that 5,200 points, which we're not too far away from at the moment, it does look like we'll be able to challenge that 5,249 point mark. But if we continue to get better numbers coming out from all over the globe, especially the likes of China as well as Japan, that's really going to help the Australian share market, especially the material space, which has been the real drag in terms of both earnings and in terms of the benchmark index over the last 2 to 3 years.
One of the issues that, Julia, many people have pointed to as a potential mover of markets has been the election. Now we've moved beyond the election. Did we have much of a reaction? Do you expect there to be lingering impact?
I think a lot of it's already been priced in, and that's because the expectation had been for such a powerful coalition win, which we have seen. Now, the composition of the Senate is still up in the air, so that still brings in a bit of uncertainty over some of the things that the government is wanting to bring in. But some of the things that the market's probably watching is the carbon tax. Now, this has been a big impact on things like the airlines, building material companies, and electricity companies over the last few years. The airlines has a huge impact. I think Qantas received a bill of $106 million in the last financial year. Virgin, they estimate $45 to $50 million. This is a company that's making an underlying profit of $82.5 million, so a massive impact there. AGL Energy, a huge impact, $580 million was their bill from the carbon tax, although they did receive compensation of about $240 million. So there's some of the companies that we're watching for potential upside from a carbon tax disappearing. We're also watching infrastructure stocks. It looks like there's going to be a huge spend in terms of rail. So that's stocks like Leighton's, Transurban, and then of course individual stocks as well. We're watching Telstra because it looks like the coalition government in favour of fibre optic to the node rather than to the home, and the impact that might have there. We're still waiting for GrainCorp and the 16th of November deadline for the Treasurer to okay the deal by Archer Daniel Midlands, and of course Macmillan Shakespeare, where we saw a sell on the fact today.
One stock in particular has chart the various fortunes of political parties, and that's been Macmillan Shakespeare. Seen as a proxy for a coalition win, and yet the day after the market gets what it wanted, or at least Macmillan Shakespeare got what it wanted, they closed down over 5%.
Well, James, no longer a proxy for the election. It's gone and passed, and I guess we saw some selling on the fact it's now time to evaluate McMillan Shakespeare just on fundamentals. And if we have a look at where McMillan Shakespeare was trading before that FBT announcement in July, it was at $15.36. Today we saw it trading at $12.70, so almost getting back to that pre-FBT announcement levels. But I guess in terms of the valuation of McMillan Shakespeare, it makes more sense to have a look at it from a PE ratio basis. And last year the average PE ratio for McMillan Shakespeare was 16.7. That compares with 15.2 at the moment, so that implies that the stock's trading at around about a 9% discount, and that's probably going to be right for McMillan Shakespeare. We really don't expect this stock to get back to the valuations before this announcement, because the memory of the possible changes to FBT is still fresh in investors' mind. So around about an 8 to 10% discount is probably fair for McMillan Shakespeare. Now this is a stock where revenue was up by 9% and net profit was up by 15% in the last financial year. This current financial year will probably see a little bit of an election impact. However, we're probably also seeing some pent-up demand in that area, so just a little bit of clarity before people actually enter into these novated leases. So McMillan Shakespeare, no longer that election proxy, and we're really just looking to evaluate this particular stock on its fundamentals with around about an 8 to 10% discount.